Hello. In this video, we're talking about how relying on past returns can be tricky, especially in the context of debt mutual funds. Now, all AMCs or mutual fund companies routinely tell their investors that past returns are no guarantee for future returns and so on. And to a large extent, investors have internalized this in the context of equity funds because everyone knows that markets go up and down, and 3-year good return track record doesn't mean much for the next 1 year because a fund is essentially pegged to a benchmark, an equity benchmark. When it comes to debt mutual funds, most investors ignore this or are less aware of this fact, and they tend to think of it for various reasons as alternatives to fixed deposits, which essentially are precisely fixed income instruments. But the reality is that debt mutual funds are essentially also volatile, not as volatile as equity funds, but definitely nowhere near as static as fixed deposits. So in this video, we'll see why. But before we actually see the drivers of this variation, let's look at why how much is the difference in the history and the future. So this graph here shows on the x-axis the historical 3-year returns annualized of various debt mutual funds over the last 5 years, and on the y-axis we see the subsequent 1-year return. So if you're analyzing this in 2017 January, then last 3 years would be 15, 16, 17, and the future 1 year would be 17, 18, as in starting from 17. So you see this box here, which is essentially great historical returns and hardly any future returns. Likewise, this side where there is great or poor historical returns but great future returns. And in the middle here, a bunch of funds. Long story short, it's while you may not draw the reverse conclusion that past good returns are necessarily an indicator of future bad returns, we can at least draw the conclusion that it's not a very good idea to rely exclusively on the past returns. Now, why this might be the case, let's look at next. What drives returns in debt mutual funds depends on what sort of fund it is, but the most obvious cases are credit spread, where you actually take some credit risk for generating higher yields, and fall in yields in the debt market. When a gilt fund with a 10-year duration goes up, delivers capital gains because yields fall, and obviously bond prices go up when the yields fall. The flip side, of course, is in case of credit spread driven yield jump, default by a company, one of the issuer companies which are there in the mutual funds portfolio can significantly damage the NAV. And in case of gilt funds, it could be that a rise in yields or expectation of rise in yields even can lead to a fall in NAV. So these become actually even more pronounced when you're looking at a falling interest rate regime, which is what we're experiencing now as of 2020. So let's look at why. Repo rate falls, that's our precursor right now. We are looking at an evaluation date, let's say at the end of this or in the middle of this fall cycle towards the end. Now, what happens at this specific point is gilt funds have great capital gains. Sometimes the returns annualized over 2-3 year window can be as high as 15% or 12-13%. Liquid funds, the historical returns look good. They'll be of the order of 7-7.5%, 3 years, 1 year also 6+ percent. Accrual funds will show great returns of 8%, 9% annualized historically, may show good returns historically. But the fact is that your evaluation date is at the towards the fag end of this interest rate cycle, and that means these things aren't going to recur necessarily in the next 2-3 years. So, in case of liquid funds, long tenor debt funds, you may essentially see that cap gains are pretty much done, and you might even see cap losses in future if yields rise sharply. Liquid funds, as is the case now, your yields to maturity are closer to 4-4.5% rather than 6-7%. And accrual funds, the biggest problem is you might actually see a default in one of the issuer companies, thereby reducing the NAV significantly in the future. So that's the long story short on individual funds and their returns. Now, How do you actually navigate all this? To that end, we invite you to check out our debt mutual fund platform called FundSage at this website. And please do write to us at ascii.systems@ascii.in with your comments and feedback. Thank you.